To sign up for more free research reports and videos like this, go to peakresources.org. The 3 biggest mistakes gold investors are making right now. 1. They're buying mining stocks. The mining business is horrible. It has been this way for decades. The miners are not the same as the physical precious metal. They are not a safe haven. They are a business and should be treated as such when viewing them as an investment. The major mining stocks, believe it or not, trade for less than they did when gold was $300 per ounce. The rising costs are crushing these companies, and that is why they have significantly underperformed the metal they mine. In our opinion, with thousands of hours of research, don't buy major mining shares. The only mining stocks we would own, and we would keep it down to 2 or 3 max, are undervalued junior mining companies that will inevitably be purchased by the majors in order to keep their production line running and costs down. You need to look for solid people, large high-grade deposits, and a business plan that is focused on rewarding shareholders. You do not want to own a junior mining company whose goal is to become a major producer one day. The mining business is extremely capital intensive. Remember, all mines have a life expectancy. They will one day mine it to where there is nothing left to mine. So these assets are constantly shrinking. Miners are also slaves to the paper markets, where 100 times the amount of physical precious metal trades. So if you ask us, mining companies are selling their products cheap due to the outright distortion of the gold price. If you want to profit from gold during the next 5 to 15 years, avoid the mining shares. If you're going to buy some, focus on finding 1 to 3 juniors where you know the people, investors, projects, and financing partners. If you don't have time to research these companies for yourself, then just stick with the physical metal. 2. Buying numismatic coins as if this were part of the diversification process for a gold investor. Don't let these gold brokers scam you, because that is exactly what it is. The numismatic market is identical to the baseball card collector's market. The market is small, not easily liquid, and only valuable to others who have this belief that a rare coin needs to have a premium. In the end, these coins are just overpriced collector's items that have nothing to do with profiting from the move we see in gold this decade. We are not bashing collectors. We have friends who like fine art, stamps, small spoons, and shot glasses from areas they travel in. If you like rare coins, please by all means enjoy them. Just never confuse them with buying a gold coin to profit from the gold price. And remember, anything that no one wants is stable. So when the dealers tell you to look how stable these coins are, of course they are stable. They aren't that liquid. They also always go up because the world is full of suckers that will pay more, not due to fundamentals, but because they have a belief that down the road, another sucker will pay more for it. The point we need to stress is that if you want to profit from gold, buy gold. It's the same thing with the mining stocks. People buy them and wonder why they're down when gold is up. Look, if you want to profit off of gold, then buy gold. The mining stocks are businesses, and rare coins are collector's items. Both of these are tied to the gold sector, but not the way to profit from the rising gold price. One final note. If we enter a depression or remain in a prolonged recession, the collector's market will dry up because it takes good times to push the values up for baseball cards, rare coins, and stamps. 3. Buying at any price. Dollar cost averaging is a fool's game. If you want to own gold, be aware that it is highly volatile. You have a global monetary crisis, so you have banks, central banks, hedge funds, retail investors, and even governments involved in this market. It takes discipline, but you should only buy gold when it is down either 5% that day or 10% that week. This will ensure you're getting a good price in a long-term bull market. The only time we would not follow our own advice is for people who own none. We believe as a matter of financial insurance, you should have at least 5% of your net worth in gold. For purchases above that, you should be patient. Don't allow the hype of imminent collapse of the economy or hyperinflation cause you to buy at a higher price in a week gold is rallying. ETFs versus physical gold. Our conclusion, when it comes to buying gold, stick with bullion or government-minted coins. Purchase gold for as close as you can to the spot price. Once you have at least 5% of your net worth in physical gold as a form of financial insurance, ETFs can be used for investment purposes since they can be easily traded. Just remember, in a crisis, only the physical gold is guaranteed gold. You should always store some of your gold in a private vault in-country and a private vault out-of-country. Remember, this is a metal wars have been fought over, so keep your ownership private, especially from your government. To sign up for more free research reports and videos like this, go to peakresources.org.